Hi, in this video, I'm going to show you how I've successfully used the ICTs fair value gap concept to consistently predict the market direction using market structure as a confluence, interest rates, understanding how the bond market moves, and its confluence with the dollar, its confluence with the foreign currencies, and the stock market as well. So a lot of these things I know for some people who are new, it's gonna seem quite a lot, but trust me, when you go through my course, you'll basically realize that it's just things that you do the analysis within a couple of minutes and you don't really need to do it again for a very long time. It's just having that understanding of how these things works. But the most important thing is if you can understand the structure of the market and then add in the fair value gap concepts, you will see how that actually works. So right here, you can see this video. I made this video in 2023 January, and right there, I said Bitcoin will shock the world in 2023. And as you can see right here in this video, Bitcoin was resting at 17,200. And if you watch this video, it's actually on YouTube, you're going to see that I was saying that Bitcoin is going to do astronomical numbers last year and this year as well. And so far, Bitcoin has hit over 40,000, which most people didn't actually expect that to happen because they were expecting a recession. And you can see right here how I use the fair value gap concept right here as an entry position into the marketplace. And if you were on this trade, you would have made thousands of dollars. Now, this is just an example, and we can look at Bitcoin right now. So Bitcoin was basically around this area then, and no one was actually interested in Bitcoin going to the upside, 17,200. Look at how many pips that is. That's about 31,000 pips. So if you were risking $10, if you were risking $1 per pip, you would have made 31,000 on that trade. So this is to show you there's basically no limits to how much you can make using this strategy. It's all about you learning it and being consistent with it. I'm also going to show you another example that I also forecasted. You can see this was 10 months ago, and you can see this is GJ. The price of GJ was at 158, and if you go through this video, you're gonna see that GJ did astronomical numbers, and I said it in that video that GJ is going to explode. Look at the price. GJ was at 158 back then, right here. And I was forecasting that GJ is gonna go to the height that it is right now. And if you use this ruler to measure how many pips that is, that's about 3,000 pips. So if you were risking $1 per pip, you would have made $3,000. If you are risking $10 per pip, and if you look at this trade right here, I basically forecasted the trade, posted the entry and the stop loss. This right here was about 20 pips stop loss. So let's say you were risking $10 per pip. That means you're risking $200 on this trade. You would have made $30,000 just holding one trade. The point of this is for you to understand that you don't need to be in the marketplace every single day. This strategy is something you can use it if you have a family, if you have engagements. I had my son in 2021 and I was a full-time dad. I am a full-time dad while also being a full-time trader. And this is all thanks to ICT concepts on fair value gaps, because I basically just annotate my zones from the higher time frame, and then I use the lower time frame as entry points. That is why I'm able to get smaller time frame entries. This entry right here was from 5 minutes time frame. And I don't need to be on my chart every single day in order to be able to get into this market. All I need is just put my alert. All I did was put my, you can look right here. Right here was the entry. Look, and you can look right here. What do you see right there? Fair value gap. This is basically one of the easiest concepts you can use in trading. And look at how price nicely came into that key level. All you want to see right here is a smaller time frame shift in market structure. And even if price takes you out, stay focused to what you're looking for. You see that again, you still look for that entry. Let's say you try to get an entry right here. The first time it took you out, and you tried again the second time it took you out, and you lost $400. This is just an example. And then the third time you were able to get into that trade, you would have made $30,000. This is how this strategy helps you to minimize your losses and maximize your gains. I'm going to show another example, and this time this example is going to be on the S&P 500. You can look right here. You can look at this video. I made this video 1 year ago. And in this video, you can see I annotated this inefficiency. This was when people were saying that we're in a recession and the whole market is going to crash. But I was seeing an opportunity, a life-changing opportunity. And right here, the inefficiency price tapped into. If you watch this video, you're going to see me say that the S&P 500 is going to create a new all-time high 1 year ago, using just one strategy. If you go through the course, you'll see that I'm not trying to teach you several strategies. The course is to teach you just one thing. One quote from Bruce Lee is, he said he is more scared of someone who's practiced one kick 1,000 times than someone who's practiced 1,000 kicks once. Does that make sense to you? It's better to be a master of one than to be a master of all and end up being a master of none. So this is just how you can see how this works. And right here, I said it was going to hit a new all-time high. And let's look at the S&P 500. Now, on the S&P 500, you can see that very clearly. New all-time high. This was the entry right there. Right there was the entry. This was the inefficiency that I was talking about. It was an opportunity to buy. Look at this. Look at this right here. This is 13,000 pips. If you were risking $10, you would have made $139,000 on one setup. Yes, you could have held it for a year, but who cares if you hold one position for a year and you don't need to even do anything else, just secure profit. And once price is going to the upside, you're using whatever inefficiency that you see at the upside as take profit position. For example, you can be using places like this. When price gets there, you secure 50%, or you secure 70% and leave the rest to run. That would have made you thousands of dollars. And also, if you go through my channel on YouTube, I also talked about the NASDAQ as well. I talked about NASDAQ hitting new all-time high. And look at what NASDAQ did. It's hit a new all-time high. Thousands of pips. Now, another one I also talked about was Ethereum. Look at Ethereum's price right here. 1,319. That was how much Ethereum was at then. And look at it right there. The same strategy, fair value gaps, inefficiencies. Right there, price came into it. And then where's Ethereum right now? 1,319. Look at Ethereum's current price. Ethereum current price is 2,302. Another one is the dollar as well. Look at this price action right here. I talked about the dollar right here. This was 10 months ago, and I analyzed the dollar, and I was anticipating for the dollar to drop up from this position. What price was the dollar then? 106. And I said I was anticipating for dollar to drop off from this key level. 106. Let's look at what the dollar is showing us. Dollar is at 103. $106. Look at 106 right here. Look at the price. Dollar came to 100. So it's basic. It's not rocket science. This is not rocket science. So this was where I was anticipating for dollar then. Right here. Let's go back to that video. You can see right here. This was the high. This was the inefficiency. This was the relative equal high liquidity. You can see that right there. You can see that. And after price tapped that key level, I want to take you to the time frame I used in the video. You can look at it right there. You can see the candle. You can see the candle. And I said this inefficiency, I want to see price come in there. And look how nicely price came to that inefficiency, tapped into it. What did we see next? Drop, run on liquidity. And this was how I knew that the S&P was going to rally, NASDAQ was going to rally, Bitcoin was going to rally, Ethereum was going to rally, by understanding the correlation between the dollar, the foreign currencies, the stock market, and the cryptos. And everything right here, I covered it in the course. So if you have any questions about anything you don't understand in the course, please feel free to reach out. I'll talk to you in the next video.